Hi, this is Matthew Cratter from Trader University, and today I want to talk about the current stock market crash that we're seeing. If you're worried about a bear market or you just want to see what I'm trading, be sure to hit that subscribe button. So today was a very nasty day to the downside. All the FANG stocks selling off, Dow off more than 1,000 points. You can see the market map here. Really, the large cap stocks getting hit pretty badly in the wake of coronavirus news and the potential it has to be a pandemic. It seems to be spreading outside of Asia. If you've been following my videos, you won't be quite surprised by this market move. Just a week ago, we talked about the high potential for a violent stock market move to the downside. And our inputs were that the market was priced to the point of perfection. From a sentiment perspective, we had UBS, their wealth management group, saying that there's no credible bear case for stocks. This is the day before Valentine's Day, even with the coronavirus in the news. And then we had this data point from Sentiment Trader that I pointed out that we had a lot of retail traders buying call options. In fact, off the scale buying. If you looked at opening calls versus closing calls. And against this whole backdrop, as we discussed and as we have been discussing, is this yield curve inversion, which signaled in late August of last year, 2019. And when you get a yield curve inversion, when this is the chart of the 10-year minus the 2-year, and when this becomes inverted, there's a very, very high chance. It's a very good forward indicator of a recession. And now with this virus spreading, if it continues on the path that it's on, it's almost certain that the world's economies, especially Europe, especially China, will be pushed into recession, and probably the U.S. as well. That's why we've been seeing this very, very violent move. Now, how are we positioned going into this? We talked a little bit about this a couple weeks ago. I was using kind of a three-stool approach. Now, the first one was momentum stocks, a bunch of momentum stocks, mostly software names. Those have just been completely killed. But fortunately, we had some hedges on. The first one was the 10-year note treasuries, the ETF. If you want to trade this using the ETF, it's IEF. And you can see this has just really exploded to the moon as yields have moved down. The 10-year note yield has moved down now below 1.4%, which I think is getting pretty close to all-time new lows. So what happens is there's this flight to quality, and in the past two bear markets, in the 2000 to 2002 and the 2007 to 2009 great financial crisis, those two bear markets, treasuries were a really nice hedge to have on. I tend to do this using treasury futures, using the 10-year note futures, or using the ultra 10-year note. An easier way of doing it that doesn't involve leverage, again, is just IEF. And then the third leg of our stool was also a hedge. And the way I like to put hedges on is I like them to have independent validity. So they're hedges, but they're the kind of thing you want to have on just because you think they're going to do well anyway. And so I think we eventually see rates in the U.S. go down to zero, as they are in many, many countries, especially all over Europe. And so I like being long treasuries, and this has been a good position to have on as a hedge. I also, in the wake of all the money printing that's going on, Fed cutting rates again, I like gold and Bitcoin. We've been talking a lot about these. Gold had a really, really nice day, and some of the big gold stocks like Newmont Mining, also really nice hedge to have on, as well as Bitcoin. Bitcoin was down on the day, but it's moved up probably, call it $800, maybe a little bit more, since I made my video about this three-legged stool, how to position in this market. So I still like, I've taken off all the momentum stocks. We talked a little bit in the last video about some of the formations we were getting. Shopify, which has been a real leader in momentum stocks, put in a very bearish candlestick after reporting earnings in early February. You can see this formation right here, and it's just been moving down ever since then. This is what often happens when it can be an advanced sign of a market sell-off when you get what's been a market leader. And Shopify has been a very strong market leader leading to the upside over the past 5 years. When these market leaders begin to break down, you have sort of advanced notice. And so this was one of the impetuses I saw to taking profits. We're also seeing some very bearish formations in some of the FANG stocks, like Amazon, for example. what we have here is it's a rough version of what's called an island formation, where you have a gap up and then a gap down, and you sort of have all the traders who traded within this area trapped in their positions. This is a very bearish indicator. It's called an island formation. You can Google that if you want more information about it. But we're seeing a lot of Amazon's another market leader, obviously, of the last 5-10 years, also topping. And so, this is not a good time to be in momentum stocks. I'd be very careful. I'm still comfortable being long gold and being long the treasuries, but I'm not going to try to pick a bottom in this. Obviously, the epidemiology of the coronavirus is pretty hard to get a handle on. What we can be pretty sure of is that the Chinese government's not telling the whole truth, and that the actual infection and mortality rates are much higher than they were telling us. But one thing that is nice about moves down like this is it gives us an indication of where market strength is. Now, if you look at this, the chart here, if you look for what stocks are green on a very strong down day like this, Gilead is up in the wake of the World Health Organization saying that one of Gilead Sciences' drugs may be able to treat coronavirus. So that explains that sort of strength. We have some pockets of strength in gold as well. And there is a momentum name that really stood out to me today that was holding quite well. Definitely one to keep an eye on, especially if this market finds a bottom. This is a Atlassian, TEAM is a ticker. You can see it found good support right here at the 50-day moving average. Also up on the day, one of the very few stocks up on the day. This shows institutional interest, institutional nibbling, and buying on the dips. So this is a strong name. You want to see what names are holding up on a day like this. You'd expect gold and treasuries to be strong, and maybe Bitcoin to the extent that's begun to function as a safe haven asset. But when you look at just regular stocks, because institutional money still has to go somewhere, Team is definitely one to keep an eye on. This is a stock I like for the next 5 or 10 years as well, but definitely one to be looking for a recovery. The last thing I wanted to talk about was how do we pick a bottom in this market? And I had a couple thoughts on that. The first one is we can look at the VIX. VIX is just the implied volatility of S&P 500 options. And if we just kind of scroll out here, you can see that in the fourth quarter of 2018, when we had a very sharp stock market sell-off, the VIX peaked around 35, 36. Now we are still around 25, and so one sign of a real panic sell-off. And once you have a panic sell-off, it becomes much more safe to buy because you've had the sort of the last seller throw in the towel. If we see the VIX get back up in the 30s, up to 35 or 36, that would be a sign that this panic may be overdone. Now, in a true crisis, if this becomes like the Black Plague or something, where a quarter of the world's population or a third of the world's population gets wiped out, heaven forbid, the VIX can go much higher. It went close to 100 during the Great Financial Crisis. But we're assuming here that this is bad. It's obviously bad for families and loved ones involved, but hopefully it's not the big plague that everyone's been waiting for. And so we'd expect to find a market bottom when the VIX gets in the mid-30s. Another way of looking at this is you can look at just where the S&P is trading, SPY, and look at the RSI. And I'm using a 14-day length on this, and the bands are at 70 and 30 here on TradingView. You can see that the bottom in the fourth quarter of 2018, we got down to about 20 on the RSI, it looks like. And so we would, right now, the RSI is it's like at 30, call it 38 or so. And so we have quite a ways to go. This suggests that this is not a move where you really want to catch the falling knife. I think what could happen next is there have been a lot of calls for a Fed rate cut. If we see something like that and we get a very strong rally, that could put a bottom in. But we're at the point now where rates are still very low. The Fed's been expanding its balance sheet. And it's hard to see, there may be, this may be one of those crises where printing more money, cutting interest rates doesn't have as much of effect as we would hope, simply because if you can't go on airplanes, and you can see United Airlines, Carnival Cruise, all these travel stocks, Delta, all just getting completely killed. Doesn't matter if you're printing a lot of money or if interest rates are really low. If you can't leave your house, if you can't travel, there are all these supply chain disruptions. So there is some debate about to what extent a Fed cut could really help things. I think the one thing that printing more money will help to do is really prop up things like Bitcoin, where there's a finite supply and it functions as a store of value. And so if we begin to see the Fed aggressively cutting interest rates again or expanding its balance sheet, I think something like Bitcoin will benefit simply because it's denominated mostly in dollars. It's a fixed supply. And so as the dollar is debased, Bitcoin should rally. Also, gold will benefit from something like this. But in terms of actually getting back into equities, there's been a lot of technical damage. I'm not one to play the hero, try to catch a falling knife. Once we get the VIX in the mid-30s, though, and the RSI on the S&P, or you can look at the NASDAQ 100, the QQQ, once you get the RSI back down to low 20s, maybe 30 or so, then you can be much more confident that a bottom has been put in. I'd be very interested in your comments on this if you have any insight into the coronavirus and how you're trading this, what names you're looking at, and what you think of the market price action. So be sure to drop a comment below if you have a comment. Hit that subscribe button. Hit that like button if you found this helpful. And also let me know what you'd be interested in me making my next video about. Thanks a lot for listening, and I'll see you in the next video.